This course is Derivative Securities. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and also as an adjunct professor of accounting and financial management. In this lesson, we will cover Chapter 11, Properties of Stock Options, out of the excellent text, Options, Futures, and Other Derivatives by John C. Hall. Starting with notation, we will use a little c for a European call option price, a big C for an American call option price, little p for a European put option price, big P American put option price, S0 stock price today, SOT stock price at option maturity, strike price K, T life until the option expires, sigma the volatility of the underlying stock price, D, big D, the present value of dividends paid during the life of the option or till the option expires, and little r, the risk-free rate for maturity T with continuous compounding, a proxy for which is generally the U.S. government treasury bill. Now we will try and get an intuitive understanding of the behavior of option prices with respect to underlying variables. Again, small c and small p are European calls and puts, big C and large P are American calls and puts. For a call option, you get to buy at the strike price K and sell at whatever the stock price is. So for a call option, whether European or American, you want K to be as low as possible, therefore it's negatively correlated with K, the price you get to buy at, and you want S to be as high as possible, since that's the price you get to sell at. For puts, on the other hand, when you buy the option, you're buying the right to sell at K, so for both European and American puts, you want the price you get to sell at to be as high as possible, positively correlated. You get to buy at the underlying stock price, so you want that to be as low as possible, negatively correlated. T is the time to maturity of the option. For European options, it's unclear how that's going to affect the option price, since for European options, you only have the right to sell on the day of expiration. American options, on the other hand, behave a lot more like insurance products, and a year of car insurance costs more than 6 months or 3 months of car insurance. So the longer you get an option for, the more it's going to cost for American options. Sigma is the volatility of the underlying stock, and you can again use the insurance analogy. Someone with a volatile record of driving a vehicle in multiple accidents is going to pay more for insurance than someone with a clean driving record. So a more risky or more volatile stock is going to have more expensive options, whether that is the right to buy or the right to sell. R is the risk-free rate. For a call option, if you wait to purchase the stock, then you keep the strike price X or K in the bank, and you can invest it at the risk-free rate. So for a call option, you want to wait to purchase and earn money on interest, so the call option price is going to be positively correlated with the interest rate. The option will be more and more valuable the more I can wait to purchase it and earn interest on the strike price K. Puts will behave in the opposite direction, because when you exercise the put is when you get the money and then get to invest it in the bank at the interest rate R. So the higher the interest rate is, the more money you are giving up by continuing to hold the put, so it will be negatively correlated. The put will be with interest rates. D is the present value of all dividends to be paid before the option expires. When a dividend is paid, the stock price drops. Therefore, that will make the calls less valuable and the puts more valuable. American options will always be worth more than European options because they can always do more than European options. A European option, whether the call or the put, can only be exercised on the day of expiration of the option. An American option can also be exercised on the day of expiration of the option, but it can be exercised at any time up until that as well. So now let's look at a hypothetical example and see under which conditions you could potentially have an arbitrage or a risk-free rate of return by mispricing of an option. So suppose we have a European call option with a price of $3 that matures in 1 year. The underlying strike price of the stock is $18. The current strike price or the current stock price is $20. So the intrinsic value of the option, S minus K, is $2. Therefore, the option has to be worth more than that. R, the risk-free rate, is 10%, and no dividends are going to be paid before the option expires. We will ask, is there an arbitrage opportunity? We will now look at equations for the lower bound of European call option prices and later for the lower bound of European put option prices. In our first example, we will consider options without any dividends. Well, we know on the day of expiration, the value of a call option is going to be the maximum of the stock price minus the strike price, or 0, since an option can never be negative. Well, if that's the case, then before the day of expiration, since we can potentially invest the present value of the strike price K, the price of the call option must be greater than either the difference between the stock price and the present value of the strike price K, or 0. In our example, we're told the stock price is currently $20, the strike price is $18, the risk-free rate is 10%, the time to maturity is 1 year. So we can calculate this amount right here, and we come up with $3.71. So the call option has to be worth more than $3.71. If it isn't, which it isn't, then there's an arbitrage. So there's an arbitrage, meaning that either the stock price is overvalued or the call option is undervalued, since the strike price is set in the option contract. Well, what you will want to do is sell what is overvalued and buy what is undervalued. So we short or sell the stock S, we buy the call option, and we invest the difference between the price of the short of the stock and the call in the present value here of the strike price K. So what is left over from that transaction is therefore going to be your profit, in this case, 71 cents. How about for puts? Is there an arbitrage in this example? So suppose that the European put price is $1, the time to expiration is 6 months, the strike price K, the price that you get to sell the underlying at, is $40. The stock price is currently $37. The risk-free rate is 5%. And again, no dividends are being paid before the option expires. So how do we determine the lower bound for a European put option? Well, on the day of expiration, if we own the put and we own the stock, we can be guaranteed to get at least K. So you're going to either be able to exercise the put if you own the stock, and if the stock price is less than K, you will sell it for K. If the stock price is greater than K, then you won't use the option. Well, if that's the case, the value of the option has to be 0, or the present value of the strike price K minus the stock price. In this example, the European option has to be greater than the maximum of the present value of $40, with an interest rate of 5% and 6 months to expiration minus the current stock price of $37, and this equals $2.01. The put option is currently priced at $1, so the put option is way underpriced. Therefore, what you would do is you would borrow the present value of the strike price, and then in a sense you can move the S to the other side here, and you would buy P and S because both P and S, or at least one of them, is underpriced, or the put is underpriced relative to the stock price. You would therefore be guaranteed an arbitrage profit of at least the difference between these two, or $1 and a penny. The next relationship we will look at is put-call parity for stocks that don't pay a dividend. To derive the put-call parity equation, we will consider the following two portfolios. Portfolio A is a European call on a stock plus a zero coupon bond that pays the strike price K at time T. Portfolio C is a European put on the stock plus ownership of the stock. So let's look at the value on the day of expiration of these two portfolios. If on the day of expiration the stock price is greater than the strike price, then the call option is going to yield stock price minus the strike price. The zero coupon bond will be worth the strike price, so the value of the portfolio will be this plus this, or the stock price. If, on the other hand, on the day of expiration, the stock price is less than the strike price, the call option expires worthless, but you still have the value K of the zero coupon bond. So if S is greater than K, portfolio A is worth S. If S is less than K, portfolio A is worth K. Now how about portfolio C, which is the put option and a share of the stock? Well, if the stock price is greater than the strike price of a put option, then the put option expires worthless, but you still own the stock, so you still have the value of the stock price. If, on the other hand, on the day of expiration, the stock price is less than the strike price, then the put option is worth the strike price minus the stock. You still have the share of the stock. If I sum these two together, the portfolio is worth K. So under both conditions of stock price greater than strike on the day of expiration and stock price less than strike on the day of expiration, the two portfolios have an equal value. Since both are worth the maximum of either the stock price or the strike price at the maturity of the options, they must therefore be worth the same thing today, or this means that the sum of the price of a European call plus the present value of the strike price has to equal the price of a European put plus the stock price. Now let's consider possible arbitrage opportunities from the European put-call parity relationship. Suppose that the current price of a European call option is $3. The time to expiration of that option is 1/4 of a year or 3 months. The strike price of that option is $30. The current stock price for the underlying stock is $31. The risk-free rate is 10%, and there are no dividends being paid before the option expires. What must be the current price of a European put option for no arbitrage? If we just look at our equation here, we solve for P, which is going to be C plus the present value of K minus S. So in this example, that's going to be the present value of $30 at an interest rate of 10%, expiring in 1/4 of a year, plus $3 minus $31, or $1.26. So if the actual put is priced at $2.25, then the put side of the equation is overvalued. So we would say that P plus S is overvalued. So you would short P and short S, the stock price. And with that cash, you would buy C and invest the present value of the strike price in the bank. And you would make the difference between 225 and 126 or 99 cents. How about if P is $1? Well, it should be $1.26. So now P is underpriced. So you would want to be able to buy P and S. You would buy P and S, and you would finance that by borrowing the present value of the strike price and shorting the call option. And you would make the difference between $1.26 and $1 or 26 cents. Will you ever exercise an option early? So American options can be exercised anytime up until the day of expiration. European options can only be exercised on the day of expiration. Well, generally there's some chance that an American option will be exercised early. An exception to that is an American call option on a non-dividend paying stock, which you would never exercise early, since you give up the safety of owning the call option and don't get any benefit from exercising it early. So how about an extreme situation for an American call option? Let's say the stock price is 100, times to expiration is a fourth of a year or 3 months. The strike price is $60. There's no dividends. So you have an option worth $40 or a deep in the money call option. Should you exercise it immediately? No. So if you exercise it, you can get $40, but you have to pay $60 to get it. So what should you do if you want to hold the stock for the next 3 months? Well, if I want to hold the stock for the next 3 months, I'm just going to keep the option and perhaps keep the money to buy it, the present value of the strike price in the bank, and earn interest on it. There's no advantage to exercising it. I'm still getting the interest out of the bank, so I just wait. What about if you do not feel the stock is worth holding for the next 3 months? Well, then I'm better off selling the call option now than exercising it and selling the stock, because the value of the call option will be worth the $40 I would get from exercising it, plus the time value of the option, and I lose the time value if I exercise it. So in the first case, I just hold on to the option, and in the second case, I sell the option. In neither case do I exercise the option. So you're not going to exercise a call early. You're not going to be sacrificing any income. You're delaying paying the strike price, so you get to earn interest on the money you would pay that with, and holding the call provides insurance against the stock price falling below the strike price. So you have an insurance product that there is no incentive to exercise. As a graphical summary so far, we can look at the bounds for European or American call options, which will be the same in the case of no dividends being paid, since there is no incentive to exercise an American call early if no dividends are being paid. So if we look at a graph of the call price versus the current stock price, the lower bound for the price of both of the European or American call is going to be maximum of the stock price minus the strike price, present value thereof, comma 0, or a graph that looks like this. And since the call just gives you the option to buy the stock, the upper bound has to be the stock. So the price of both the American and European calls as a function of the underlying stock price has to lie in this region. Should puts be exercised early? There are some advantages to that. So there are any advantages to exercising American put when, in this case, we have a deep in the money put. So the strike price is 100, the stock price is 60. There is an intrinsic value to the put of $40. In this case, there's no dividends being paid. The risk-free rate is 10%, and we have 1/4 of a year or 3 months to maturity. Well, if you exercise the put, you get $40 that you could invest at the risk-free rate and potentially make money. So that's an advantage to exercising it. If you don't exercise the put, then you can potentially make more money if the stock drops even more, and you have the guaranteed sale price of 100, so you still have an insurance product. So it's a trade-off between the insurance value of the put and the extra interest that you would get from exercising the put and the guaranteed value from exercising the put. You can, of course, sell the put. What about upper and lower bounds for European and American put options? Unlike the call options, which they're the same, the put options will be different. There can be incentives, as we noted, to exercise a put early, so the American put will be worth more than the European put. On the day of expiration, if you have the stock price go to 0, then the value of the put would be the strike price, K, so that has to be the maximum value of the put. In the case of the European put, you cannot exercise it early, so it has to be the present value of the strike price. So for an American put, if the company goes to 0, you can exercise it today and get K. On the other hand, for a European put, if the company goes bankrupt, S goes to 0, you have to wait till the day of expiration to get K, so it's worth a maximum of the present value of K. How about the minimum value? Well, we know that the intrinsic value of an American put is maximum of K minus S naught comma 0, and again, the American put can be exercised anytime, so you're going to get maximum of K minus S comma 0 for the American put. The European put, on the other hand, you have to wait till the day of expiration, so the minimum is going to be the maximum, the present value, again, of K e to the minus RT comma 0. So this is going to be the region of valuation for the European put. This is the American put. The American put, it's going to have a higher minimum, since if you get deep in the money, there is an incentive to exercise early. How about if we have stocks that pay dividends? Well, if you have a dividend paid, it just lowers the stock price. So for our lower bound for both the European call and the European put, you just replace S with S naught minus D. And again, there's a negative here, so it's S naught minus D gives you a positive D. And you get these revised lower bounds for the value of the European call and put. What about put-call parity for American options? Again, it's a little bit more complex. This line right here is put-call parity in the case of European options. Well, how do we adjust that for American options? For the put, we can rearrange the equation, solve for P, and then we will say P equals C plus present value of K minus S, and we know that the American put is worth more than the European put, so we can just say that P is greater than this equation here. Well, the value of the American call is the same as the value of the European call, so we can replace the little c with the big C, and we just get the value of an American put is going to be greater than the value of an American call plus the present value of the strike price minus S naught. We'll rearrange this by subtracting P from this side, moving this to the other side, and therefore we'll say that the difference between the American call and the American put has to be less than S naught minus present value of the strike price. So this is going to be half of the equation we will derive for a put-call parity relationship for Americans, similar to this one for European options. To derive the other half of the put-call parity relationship for American options, we will consider the following two portfolios: a European call option and an amount of cash equal to the strike price of the European call option, and we will compare that with an American put option plus the underlying stock. On the day of expiration, the call option is going to equal the maximum of S divided by K when exercised minus K, the amount of money you would have to invest to exercise the option, or otherwise the maximum of S naught minus K comma 0. The amount of money K, the strike price, will grow in value up until the day of expiration to KE to the RT. If we look on the other side, the American put option plus the stock, well, if the put option is exercised, you will get the amount of money K. If it is not exercised, you will still have the stock value. So if I compare these two relationships, this side is always worth more than this side due to the time value of money. This minus this will always be positive. These two are the same. So if on the day of expiration, this portfolio is going to be worth more than this portfolio, then they always have to be this portfolio more than this portfolio. We know in the case of non-dividend paying stocks, the European call C equals the American call big C. So we have the value of the American call plus the strike price is going to be greater than the value of the American put plus the stock. If we arrange this, we have big C minus big P has to be greater than S minus K. So if we put those two together, we get this relationship for the bound of the American call minus the American put. It has to be less than S naught minus present value of the strike price, and it has to be greater than S naught minus K. For European options, we already had a relationship for non-dividend paying stocks. To get the relationship for dividend paying stocks, we again just take S naught minus D, puts a D over here, and we end up with this more general relationship for put-call parity for European options that pay a dividend, or stocks that pay a dividend. For American options, again, you will just take the relationship of S naught goes to S naught minus D, and that will lower this lower bound, S naught minus D. We don't change the upper bound, and we end up with this more general relationship for put-call parity for American options that pay a dividend. I thank you for watching this video.